I wanted to start this part of the session by talking a little bit about shareholder activism, and I have to confess I am a shareholder activist. I have engaged, as they say, with some of the very largest companies, certainly in Europe, with Suarez, with HSBC, with ENI, to name a few, and I just want to give you some thoughts and some reflections on why this might be something that's important, but not just for us, but it might be something that all shareholders need to think about when they buy shares in a company. Before we get into that, I just want to paint a little bit of a picture here. We know, and I think it's indisputable, that the large corporation has been of immense benefit to society. We've derived immense scale benefits. They've provided research, technology. They've brought costs down. They've created distribution networks that have transported things across the world and made it possible for us to have the standard of living that we do have today. So the large corporate is probably one of the best inventions, if you like, of the 19th and 20th century economies. But to get the large corporation, we've had to have a trade-off. And that trade-off has been through the joint stock company, because shareholders have not been able to control, not many shareholders. To create a large company, people have to pool their resources, and we've created stock markets to enable them to have liquidity so that they can sell their shares while the corporation continues to exist. Because in the old partnership model, remember, when the partner went, the company went. So one of the great advantages of the joint stock company, of the limited liability company, is the ability to separate the shareholders from the company, and for the company to continue in existence even if the shareholders decide they don't want to hold on to the stock for whatever reason they want. So they have liquidity. And this is an immense benefit too for people trying to plan their lives, the pattern of their expenditures, insurance, pension fund arrangements, etc., without having to worry too much about the corporations that they have to invest in, or they invest in from time to time. So these are the sort of positives of the background. But there is a negative, and that negative has become ever more apparent, particularly in the last 10 years as the corporations have become bigger and bigger and bigger. I just want to draw, there are lots and lots of issues with this thing that go into the whole world of social investing, which I'm not going to talk about more generally, but I'm going to talk about a very narrow part of this thing, which is how shareholders and how decision-making at a corporate works. For the system to work, and this is the theory in company law nearly everywhere, the idea is that the shareholders have the residual liability. When everything goes wrong, the shareholders bear the losses. That's in fact why shareholders make profits in the system. But what happens when a corporate loses its way? Do the shareholders at that point engage with the corporate and try and fix the problem, or do they sell? Now, the larger the corporate, the bigger the problem, because any number of small shareholders really can't have an effect on a big corporate that has lost its way. You've got a further problem, which is that as we've institutionalized, for very, very good reasons, the asset management industry in pension funds, in asset managers of one kind or another, hedge funds, etc., we've separated, for very good reasons, the economic decision-making about whether a share is worth buying or selling at a particular price from the issues of control, who votes the shares. Usually, the fund manager makes a decision about the economic issues to do with the stock, buy, sell, how much weighting you want to put on the position in the portfolio, etc. And the decision about voting has traditionally been secondary. In fact, if you try, as I have tried, to find who owns the votes of the big companies, it's very difficult, because when you typically what happens is that the nominee will control the votes, but the nominee may lend the shares out to a short seller who will have, strictly speaking, the right to exercise that vote, and then he may have sold it on as part of his short selling activity. So the person who bought the stock will have the right to vote that stock, but the fund manager may not know who that party is. So you get this whole chain, and unraveling this chain when a particularly complex decision has to be made is almost impossible. Not completely impossible, because things are beginning to change. But for a very, very long time, it was certainly the case that the fund managers did not know who actually owned the votes of the stock that they had invested in. And certainly, on many, many occasions, the companies, the asset managers themselves, could not tell you how many votes they controlled. They could tell you how many shares they had, but they could not tell you whether they controlled those votes or not. The result was that very often votes were being cast, usually in favor, and usually by proxy, in favor of board resolutions for want of any other system. And so the system that we have today basically gives boards very significant influence and authority. In fact, gives boards virtually the only say in corporate decision making. Now, if you're a small and medium-sized company and you've gone off the rails, the chances are someone's going to turn up and offer to buy you. So what is the ultimate sanction for a small and medium-sized company? The answer is takeover. And there's and has been a very active market in corporate control. But what if you're a very big company? What if you're Shell or HSBC or JP Morgan and you've gone off the rails? Who will take you over if you're not in trouble, but you're just off the rails? And this is the problem that the activist is set up, if you like, to try and solve. The bigger the company, the bigger the problem. But you've got a set of companies which are systemically important. We can't allow them to fail. So we can get to a point where we can quite legitimately say, well, Exxon's made a right, mess of a particular situation, and in the nature of things, we'll let it go bust. It'll resolve itself, and whatever the outcome, so be it. Okay, we've had a situation like that with Enron in the early 2000s. We had WorldCom, which also fell prey to these kind of issues. They resolved themselves, they went bust, etc. No problem. But then we've got a set of companies which, as I said, are systemically important. And because they're systemically important, we can't just let them go bust. I'm talking about the banks. And because we can't just let them go bust, we end up with a vacuum at the heart of decision-making at the banks. And this has been so for a long time. The reason that we can't let them go bust, and I think we've had the whole situation in Cyprus, and I'm sure that everyone's kind of followed at least part of that story about the attempted haircut for the small depositors, and certainly the almost seizure, really, of the large deposits. But it's just worth bearing in mind that when you make a deposit in a bank, you are surrendering your cash in exchange for an investment in the credit of the bank. That's no different, in fact, than you buying short-term credit in any other company. Could be a share, short-term credit in Vodafone, short-term credit in Shell. That's what you're doing as a depositor. And in theory, apart from the systemic issues, and we'll talk about guarantees in a minute, in theory, if the bank goes bust, you stand a good chance of losing your money, like any creditor in any company. So all creditors, that's all of you who have deposits in bank accounts, are in the same position as every other investor in that company. You obviously you're more protected because you're standing behind a lot of other parties in terms of who loses money first, but there is that possibility, okay? And I bet you that hardly any of you have, in fact, I don't know of anybody here, there's probably one person here who works with me who's looked at the credit of the bank he invests in, but I bet you that hardly anybody here has looked at the accounts of the banks that they invest in. And given that deposits make up very, very significant proportions of bank balance sheets, you are the creditors who are not paying attention to what is going on in the banks, okay? And the reason you're not paying attention, I guess, is that you think they're safe as houses. And that's probably right because the government is offering you a guarantee, at least for investments of up to 100,000, I think it's pounds in the UK, certainly euros elsewhere. Whether the governments can actually honor this in a real crisis, in a real systemic crisis, is a moot point. But for the moment, that's how the system works. You don't have to think about it that much. Financial journalists don't write that much about the credit of the companies from a depositor's point of view because it's not that important. But if it became important, Stuart Kirk from Lex would be writing about which bank is better than which, and in terms of a depositor's interest and how you should be thinking about that. So we have a problem here. If you were Vodafone or if you were Siemens and you started taking big risks, the creditors would start to get nervous. What the creditors would do is to start changing the terms on which they lend to the companies. They would ask for higher rates of return, the higher the risk. You can argue whether the rating agencies are any good or not, but they might have something to say about it too. And the companies would get some feedback from the credit market quickly about what was going wrong, and that would be some signal to change behavior. Very often, creditors, so the kind of people that invest in Vodafone would be large institutions really buying the bonds of companies like Vodafone and Siemens, etc. And they would have various kinds of agreements, covenants with the company that says that they can't lever more than so much, and if they lever so much, they can't pay dividends until they've recovered their positions. These are typically what we call these credit covenants that are designed to protect the creditors as a whole in terms of the capital structure, so the amount of debt and equity in the business, and that would act as some kind of feedback mechanism for the corporate. But when the creditors are by and large depositors, you and me, and we don't really care that much because someone has offered us free insurance, the banks don't get that feedback from their creditors. We don't say, this is a risky bank, you must pay us more on our deposits or we're pulling out. We don't say that to the banks. And the result is that when banks start to take bigger and bigger risks, we don't change our behavior. So if things are going well, they take more and more risks because it can produce big returns. Of course, when things go badly, we have a big problem here because the governments have to step in here and do something about it. So this is the sort of background to the issue of shareholder engagement. There's one more issue that we have to put on the table, really, in terms of shareholder engagement. I say this because other people tell me it's true. I'm not that sympathetic to the argument on the whole, which is that companies tend to be short-term in their thinking and that they are taking decisions on too short-term a basis, and a lot of that is attributed to the fact that shareholders tend to sell their stock if they don't like what the company is doing. And the feedback mechanism for the bank is the share price. And because when the share price starts to fall, they change behavior. But because the argument is that investors are short-term in their demands for return, the companies respond to that by being short-term in their investment horizons. And so there's an argument that is damaging the market. This all comes down to the question of how much influence does a shareholder have over the corporate. And the reason I'm not that sympathetic about it is, if you were if you were 70 years old or 50 years old or, I've said certainly over 50 years old, and someone said, don't worry, it's a 50-year investment, you'll be fine, you might gulp, right? Because the probability that you survive just on the statistical tables, that your life expectancy just on statistical tables is probably another 25 to 30 years. And if someone said the first 25 years might be rubbish, but it's great after that, you might not be that happy about that investment. If you were 18 years old, it might be different. You might say, okay, first 25 years, I'll put up with the rubbish. And then you produce stellar returns for the other 30 years, and that's great. So one of the problems is that as the population ages everywhere in the Western world, we are going to find that the weight of money is going to get shorter and shorter and shorter in terms of its horizons. Or if companies try to buck that trend, they will end up being sold to people who have longer term horizons, like the sovereign wealth funds and investors. And that might not be a bad thing. I'm not saying that it's a good or a bad thing. I'm just saying that shareholders are entitled to exercise their own view of what the investment horizon should be for a corporate. So that brings you to the question of where we come in, and that is, how is this system actually meant to work? Now, one of the things that this system does is to put a very, very, very high burden on the boards of companies, because in effect, the party that controls the board is the party that controls the company is the board. The Saltz Review, Anthony Saltz did a very interesting report on Barclays, and one of the things that he identified in this was that the board of Barclays, he says it himself, not me, so it's not controversial that I repeat this at the LBS, for those who know what I'm talking about. He said that many of the executives did not have the skill to be able to understand what was going on, and therefore could not challenge. And the executives who did have the skill did not have the time. And so we had a problem. Now, this can't be true just of Barclays. It's probably true of a number of other institutions as well. So what the activist does is to engage. What the activist does is to step forward and to start a debate with the corporate. Now, we are actually, as activists, and I think it's true of all activists, funded by the institutions to actually play this role. And our job is to analyze the corporate and to start a debate. And it doesn't mean that we're right. It doesn't mean that people should do what we say. But we do try and ask the questions that provoke an engagement and a response from the board of companies. It's a very, very, very difficult task. It involves a lot of courage in the face of people who've risen to the top of the very largest institutions, not by deferring to other people mostly, and you do get a certain fire and brimstone. There is a very famous example of this, and I don't mind repeating it here because it was said in a public forum. Jamie Dimon, the chief executive and chairman of JP Morgan, when asked by an analyst a very legitimate question about his position on capital and capital structure, said to the guy that he was talking rubbish, and when the guy responded, he said, "That's why I'm richer than you." That is, okay, so what Jamie Dimon was saying is, I'm not interested in what you have to say. I'm doing this because I can, and nobody's going to get rid of me. So what an activist can do, like us, is to engage. It's very important, I mean, just to intersect with the first segment, that the debate requires us, because really, with the large corporates, most shareholders are very, very small. And in the scale of these companies, we rarely have more than 1 or 2% of the stock. We're talking about $100 billion companies here, so very, very large companies. Very large position in the stock, and the result of that is that we need the press and everyone else to join in. So I finished this one message back to you, which is, you're all, to some extent, involved in this thing, and it pays for people to pay attention and to engage with the corporates that they invest in.